Unfortunately, tax loss harvesting can't be used with retirement accounts. So 401ks, IRAs, Roth IRAs, SEP IRAs, simple IRAs, 403bs, etc. You cannot use losses in those accounts.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 117. This week I'm going to talk about how to lower your income taxes with tax loss harvesting. But before I get into that, if you could please go to retirewithryan.com and complete my 2022 listener survey, I would greatly appreciate the feedback. And while you're there, if you scroll down the homepage a little bit further, you'll see information about my retirement readiness workshops that are starting soon. If you don't have a plan for retirement, or if you need to update your plan for retirement, please consider attending one of these workshops. Wouldn't it be nice if every investment you made turned into a winner? Well, unfortunately, that is never the case, and there are times where your investments are down in value from what you paid for them. But there is a strategy that allows you to benefit a little bit from this loss. And this strategy is called tax loss harvesting. And this is one of the many tax strategies that you should consider as an investor. And the way that tax loss harvesting works is that you sell the investment that is down in value from your purchase price. Essentially, that's known as a loss. And you then can use that loss to offset other taxable capital gains that you have that year, or reduce your ordinary income for that year by up to $3,000. And if you then want to still have that money participate in that investment, you could reinvest that money into a similar investment so that you don't miss out on any recovery. Let's say it was a stock, you could invest it into a similar stock. Or you can wait 30 days and then repurchase that same investment. But you don't want to buy that same investment back within 30 days, because if you do, you're then canceling the loss, which the IRS defines as a wash sale. So let's walk through an example of how this works. Let's just say you sold some investments earlier this year that had a short-term capital gain of $20,000. And assuming that you're in a 30% state and federal tax rate, that means 30% of $20,000 would be $6,000 in taxes that you're going to owe when you file your taxes this coming April. But you have some other investments that now have a loss of $25,000. You sell those investments so that you can offset your capital gain of $20,000 with that loss. That leaves you with a loss of $5,000. If you then have no further gains for this tax year, then you can take $3,000 of that $5,000 loss and use that as a deduction against your ordinary income. The remaining $2,000 of loss can be used to offset future gains the following tax year, or you can continue writing off that remaining $2,000 loss against your ordinary income the following year. So that's one example of how that works. Another example would be that you have an investment that has a long-term capital loss of $15,000 that you currently own, and you'd like to take that loss. You then would sell that investment this year, and if you have no other capital gains for this year, then you're able to take $3,000 of that $15,000 loss, take that as a deduction on your taxes this year against your ordinary income, and then you would carry forward the remaining $12,000 loss to either use the following year off any other gains, or you could continue writing off that remaining loss up to $3,000 per year until you've used it all up. And long-term losses don't have any limitation, so that you can keep using them over your lifetime to offset future gains or to write them off as ordinary income deductions. But there are some factors to consider when you do tax loss harvesting. So one is that, unfortunately, tax loss harvesting can't be used with retirement accounts. So 401ks, IRAs, Roth IRAs, SEP IRAs, simple IRAs, 403bs, etc. You cannot use losses in those accounts. Second thing to know is that losses need to be first used to offset like gains, meaning that If you have long-term losses, those losses first need to be applied against any long-term gains, and then any short-term losses need to be applied against any short-term gains. So once you've done that, if there are still losses, then you're able to take those losses on your taxes. And third, be aware of the wash sale, as I mentioned earlier, which means that you can't sell an investment at a loss and buy a substantially identical investment within 30 days before or after the sale, or the loss is disallowed for current income tax purposes. And unfortunately, our government has not provided a straightforward definition of what it considers substantially identical. You'll kind of have to use your best judgment on that. So let's just give a few examples of that. Let's just say that you own Pepsi stock, the soda company, and you have a loss on that, but you want to stay in the same industry because you believe the soft drink industry is going to do well the following years. Well, you could sell your Pepsi and buy something like Coca-Cola. Let's just say you own Lowe's home improvement stock and you believe the housing industry will do well, or the home improvement industry will do well the next few years. You could sell Lowe's and buy Home Depot. Now, if we talk about funds, it gets a little more complicated. So I'm a big believer in index funds. If you haven't listened to my recent episode, the difference between a mutual fund and an index fund, I would check that out. And I'll put a link to that in the show notes. But one thing you could do, let's just say you own an S&P 500 index fund. You could sell that index fund and buy a similar index fund, but one that is tracking a different index, such as the total stock market index or the Russell 1000. So these are very similar. They have a lot of overlap in the stocks that are in these indexes, but they're different enough that you'll probably be okay for the IRS. The fourth thing is that be aware that this loss rule applies across all of your taxable accounts, meaning that let's say you have multiple accounts, one account at Charles Schwab, another at Fidelity. You sell one investment in your Charles Schwab account for a loss. If you buy that same investment back at Fidelity, you've then violated the wash rule. So it applies across all of your taxable investment accounts. And this was ruled on a number of years ago by the IRS, Revenue Ruling 2008-5. I'll put a link in that to the show notes, which also said in the ruling that this applies to in your spouse's accounts and or your retirement accounts and your spouse's. So you really have to be careful that if you take this loss in your taxable account, that you're not buying that investment in your retirement account, or maybe you're making an automatic investment plan in your retirement account. You might need to suspend that for up to 30 days so that you don't void the wash rule. And the last thing to know about this is that options count too, meaning that if you sell an S&P 500 index ETF and then within 30 days you buy an option on that because you think that the market's going to go up, you've then created a wash rule also. So you have to be aware that it applies across all your accounts, your spouse's accounts, and unfortunately, it applies with options as well. So your homework should be now that with the stock market down, to look over your taxable investment accounts, to look over the cost basis report. You can usually find this by logging in online. It might be on your statements or talking with your advisor to see if there are any current losses. And if there are, you should definitely consider selling those investments, but buying back into similar investments. So if you own an S&P 500 index fund, sell that, consider buying a total stock market index fund or vice versa. And this is also a good time when you have these losses to maybe consolidate investments, to maybe get rid of, if you have a lot of investments, maybe to consolidate that down to a smaller, more manageable amount. Or it's also a good time to consider switching from mutual funds to ETFs. As I mentioned that earlier episode, I talk about the tax efficiency of ETFs versus mutual funds. And ETFs over the long run are probably going to save you a lot of money in taxes. So it could be a good time to consider switching to those. So I hope this episode was helpful to give you some understanding on tax losses. Unfortunately, it's not all bad when your investments are going down. Over the long term, your investments should come back in value if you're invested in quality investments. But this is a good time to take advantage of some tax losses, because if you don't take advantage of them and you eventually sell those investments down the road, you will pay capital gains. So why not capitalize on the losses now to use those to offset those future gains or to offset some of your ordinary income? So as a reminder, if you could go to retirewithryan.com and complete the 2022 listener survey, I would greatly appreciate that. I want to continue to make this the best retirement podcast that it can be. And with your feedback, I can continue to do that. Thank you for listening, and I look forward to talking with you next week. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.